The United States' debt was downgraded to AA+ from AAA by Fitch this week, who cited fiscal deterioration, high and growing government debt burdens, and erosion of governance relative to AA and AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and last-minute resolutions. A bit of historical context to wrap our minds around this news and ongoing debt escalations. It took the United States 209 years to accumulate its first $1.8 trillion in debt by the year 1985. But after this latest debt ceiling deal, the nation added $1.8 trillion in debt in a mere matter of 2 months. So a growing federal debt sum that took over 2 centuries to pile up and roll over has recently taken merely 2 months to match in nominal debt escalation. According to the U.S. Congressional Budget Office, we're only getting started with U.S. fiscal deterioration and growing government debt burdens. They recently projected annual U.S. federal debt budget deficits of near $3 trillion per year a decade from now, but all while seemingly escalating year after year from here to there. Meanwhile, we already see interest on our current U.S. debt burden near $1 trillion a year in current costs ongoing. Yields on 30 and 10-year U.S. bonds ran up walls this week, illustrating weakening appetite to lend long-term to this growing debt quagmire. Former New York Fed employee points out why the U.S. Treasury is going to have to surge its debt issuances to come. On a historical basis, ongoing tax receipt data is a better indicator than more easy-to-rig GDP numbers regarding oncoming recession potentials. And not only on the federal level are tax receipts plunging of late, but on the state and local levels as well, they have fallen to historical low levels. The head of the U.S. Treasury used typical denial tactics, citing not all that much of substance in her recent commentary of this debt downgrade.
Fitch's decision is puzzling in light of the economic strength we see in the United States. I strongly disagree with Fitch's decision, and I believe it is entirely unwarranted. Its flawed assessment is based on outdated data and fails to reflect improvements across a range of indicators, including those related to governance, that we've seen over the past 2.5 years. Despite the gridlock, we've seen both parties come together to pass legislation to resolve the debt limit, as well as to make historic investments in our infrastructure and American competitiveness.
For a further historical perspective regarding the first time the U.S. debt was downgraded back in early August 2011, the opposite of what occurred this week, we saw back then gold rallied on the news, moving up about $250 an ounce higher within a month. Escalating over $1,900 an ounce to follow as the fiat US dollar sold off in relative value versus other major fiat currencies at the time. The US stock market at the time chopped lower on that first debt downgrade, floating at around $1,200. I bring that up to show you that in terms of the ongoing S&P 500 divided by the spot gold price, with some of the worsening fundamentals that we've just covered, the overpriced stock market index at the moment is currently 2.3 times the spot price of gold. But back in late August 2011, it got below 0.7. So a simple repeat of gold outperforming the S&P 500 again would mean gold holders from here to there could essentially buy more than 3 times that US stock index in the future if we merely roll over to that level. Now, of course, I've expressed this before, but I think that in the coming gold mania, a conservative long-term target would be this level from August 2011, but it's probably going to blow by that. The reason being, after all, the attitude of our financial authorities has not changed much, and certainly not in their actions. It's only gotten worse. Have a listen to the first maestro's blunt commentary way back in August 2011 of the first debt downgrade and what he had to say about that.
Are U.S. Treasury bonds still safe to invest in?
Very much so. I think this is not an issue of credit rating. The United States can pay any debt it has because we can always print money to do that. So there is zero probability.
So the playbook's simple. They're just going to keep printing and burring item to come. Of course, it's unlikely the U.S. government will ever legally default on this ever-growing debt pile, as Alan Greenspan would say in that brief clip there. But I cut him off because in real terms, the likeliest long-term play is that they're going to pay it off in less and less real value over time as the underlying fiat currency sharply devalues further. Stay tuned on the other side of this message. We're going to cover a bit on how silver is poised to be a huge beneficiary of growing ongoing demand, not merely monetarily for stackers around the world, but also on the industrial side. As an all-time fiat US dollar bear is likely not far off in our future, and in that scenario, silver is the inverse. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates, and be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce Silver Eagle coin giveaway.
Want to win 500 Silver Eagle coins just like this guy?
Yeah, this is Kevin.
Hi, Kevin. This is Dr. Tyler Wall, CEO of SD Bullion. I'm calling to let you know that you won the SD Bullion giveaway of a monster box of 2022 Silver Eagles.
Unbelievable. That is awesome.
So click the link below for your chance to win.
Good luck to all of you out there who enter our free 500-ounce American Silver Eagle coin giveaway sweepstakes. Contrary to what many might have guessed this week, both gold and silver sold off as the debt downgrade news hit, and the fiat US dollar rallied in the face of that news. The spot silver price finished just over $23.60 an ounce bid, while the spot gold price closed just over $1,940 an ounce bid for the week. The spot gold silver ratio climbed to 82. Circling back to the bullish setup for silver prices to come, I mean, technically, you're looking at a long-term chart here that ranges from roughly 2007 all the way through 2026. And obviously, on a technical level, the chart illustrates that there's been some coiling, obviously, and some side action here, and some basing that has been building here. And when silver goes, it likely will have a lot of explosive upside. Reports out of China are silver solar demand keeps steady as offtake continues out of the Shanghai Futures Exchange warehouse inventories. And Metals Focus, a consultancy in the seemingly lawless city of London, had a widely shared report this week regarding continually growing industrial demand for silver. Basically, industrial demand for silver has been growing ever since 2010 pretty steadily. Just over half of silver's ongoing demand is to keep the quality of our lives improving by using it for real-world applications in things like electronics and increasingly into more and more solar panel cells and manufacturing, which is often happening in China. Actually, it's happening in China right now at a record size and scale. Metals Focus basically had to admit in their report that $30 an ounce silver remains a large line in the sand, and that the building ongoing silver supply deficit situation may still get worse with increasing silver solar demand estimations escalating through 2026. All while coming price volatility could attract more speculative silver buying to come. My strong bet remains that yes, there's going to be massive speculative silver buying to come, and it's going to overwhelm this system. I would strongly suggest we're going to see plenty of action for silver by 2026, and most of that coming volatility will be to silver bulls' liking. That will be all for this week's SD Bullion Market Update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.